Good morning, everybody. Welcome from my part. My name is Michel Dewolfs. It's a little bit weird, but I am WICI Belgium. And we created together with my colleagues WICI Europe, and we are so proud to be able to announce that here in this session today. I would like to have you have some movement. So. Because I will make it a little bit interactive, don't expect too much, it will be short. I have here a book, and by coincidence, Ian had the same book with him. Who knows this book? It's about the end of accounting from Lev Baruch. And who read the book? Okay, well, problem is I cannot see how many people that raise their hands online, but they will tell me. I would like to start with a quote from out of the book. I'm not talking about the age of the book because it's all since a number of years. And I want to talk about the difference between market cap and book value. And the 80s, and I'm going to quote out of the book, the 80s were marked by the emergence and steep rise of intangibles. Revolutionary changes shifting economies from industrial to information age. I would call that knowledge economy. It all triggered no change in accounting. And it seems that accountancy is resistant to change. So let's have a discussion on that. I want to introduce my speakers, the members of my panel. I will go from left to right. Here on the first place is Pietro Gasparri. He's coming, well, of course, you can hear it already, he's coming from Italy. To present him, it's not easy because he has a lot of heads. He's doing a lot of things. He has a professional profile in M&A, sustainability, and he has a double view as a user and preparer, financial analyst. He is in use of the intangibles in the M&A activity. And he is also, and now I will put some electricity in the room, he has a role in Unieuro. It's a company of electricity in Italy. Ian, second, he is head of accounting, group finance at Roche in UK. And then I'm happy to introduce, as a third person, Tjeerd from ABN AMRO, ex-colleague of mine. I'm sorry, I'm an ex-banker. And he has a head more than only a bank because he also has some links with IFRS and many, many more. So now I'm going to take my place and I would like to ask Ian to quote some things and then Pietro will, based on the slides, explain what he is doing. And then, of course, we will have the view from a banker to termine the session. I hope we are going to have a great discussion, not a fight, but a great discussion. Thank you. Ian, the floor is yours.
Thanks. First, the usual caveat, this is spoken in my personal capacity and not necessarily that of Roche or the company. I'm actually Swiss. I'm someone who's executed a successful Brexit strategy. So if you never met anyone who did that, I'll do autographs afterwards. Joking aside, I mean, from Switzerland, we're very grateful to be able to participate in such events, and particularly with EFRAG and so on. They've always been very welcome to Swiss participation. Switzerland's part of Europe, so thanks. On intangibles, Stefano said, could I summarize it in 5 minutes? And actually, I can summarize it in 5 seconds. The financial reporting for intangibles is nonsense. I can give you a sort of concrete example. What we're doing now at Roche, we're in the middle of our annual impairment testing exercise. So I've had my team for the past couple of months, couple of people, chasing the business around to do all these valuations for the intangible asset testing, including the goodwill. Our friendly Big Four auditors have been spending a lot of time auditing this. It's their #1 topic because the audit regulator is on their back on this. And this will all be presented to our audit committee on Friday next week. When I get back, I'm going to have to do some work on it over the weekend to do all this. And we will produce all of these numbers, which are useless. What will we do with these numbers? We will take them out. We will kick them out of our internal management accounts. We will kick them out of the internal KPIs. We will kick them out of our external APMs that the investors and analysts used. If we didn't do that, the investors and analysts would kick them out themselves. I support our M&A team doing due diligence exercise. If I'm looking at a potential target's balance sheet, if they've got goodwill on the balance sheet, I will just put a red line through it. We're not paying a penny for that. And if they've got intangibles on their balance sheet, I'll put a red line through that because there's a number there, but that's not necessarily representative, A, of what it's worth, or B, what we will pay for it. So the exercise in the literal meaning of the word is useless. And the worrying thing is, we all know this in the accounting profession. We all know this, and it's been a collective failure to address this topic. And it's good that it's on the agenda for the ISB, but I think the topic goes way beyond just adding more disclosure on top of it. I think it needs some really fundamental rethinking. And the book you showed, actually, if you read just one book on accounting, read that one. And I won't go into it, happy to do so, but basically what they talk about in that book is a really good starting point to actually fix the financial reporting. And maybe just to add one final point, financial reporting and ESG, two different things. You need to fix intangible assets and intangibles financial accounting regardless of ESG. You know, if you did no ESG, you still need to fix that. All of these points still apply. But the opposite isn't true. If you want to develop your ESG reporting, you have to have a strong foundation in the financial account. You need to know what the numbers are and what they mean and what they don't mean and what they are and what they're not. So you need to fix the financial accounting for intangibles, intangible assets to really have meaningful ESG reporting. The second one I say is it's the quote from earlier of chasing two hares and catching neither. Part of what a lot of what derails intangible assets is the whole goodwill topic of holding management to account for M&A deals. And goodwill, it's the Bermuda Triangle of financial reporting. You know, somebody goes off on a project, you don't see them for 2 years. Oh, I was looking at goodwill. Did you find it? No. And if you don't believe me, you can look at what the FASB and the ISB have been doing for the last 2 or 3 years about wondering whether goodwill should be amortized or not. The true answer to this question, I can tell you exclusively, write it down. The true answer to this question, who cares? Because whatever you do, people will just take it out. But yet, it's kind of an article of religion, the whole goodwill topic. So I'd say you need to fix intangible assets, and you need to hold management to account for M&A deals, but they're two different things. And if you try to use one bullet to hit both, you're just going to fire in the middle of the target and miss it, which is basically what's been happening with the whole goodwill topic for the last 20, 30 years. Sorry, that was probably longer than you wanted, but...
No, it was great. I will ask the people from audio to launch the presentation of Pietro. Pietro will talk about a specific case. We will not mention the name, of course, because he just lived an M&A case. And so please, your experience, please.
Thank you, Michel. And first of all, I would like to thank WICI Europe for the invitation and for having the opportunity to explain to you, to show to you our approach to intangible. And also to show how a small cap, because Unieuro is a small cap, our market cap currently is below 200 million euros, is approaching the intangible in its day-by-day business and in its M&A. Few words about Unieuro. We are the market leader in Italy in the consumer electronic and household appliances, with a total total revenues of 2.9 billion euros. We have approximately 5,700 employees and more than 530 stores in Italy. We are listed in the star segment of the Italian stock exchange. I would like to start with my professional profile. As Michel said, I think it's quite peculiar because it's combined my responsibility for sustainability and M&A. Apparently, there are not connections between these two areas, but in the end, there are connections. And I think it's a concrete example on how sustainability is becoming more and more strategically from a company. Last May, we presented our last strategic plan, and sustainability is a key enabler of the strategic plan, with more than 30 projects that we have in the sustainability plan. And also in the M&A, we pay great attention to ESG aspects, to the ESG factor. I'm not referring just to policies, to certification, but I'm referring also to intangible. Before talking about the M&A activity, I think another aspect I would like to point out is that my previous professional experience was in an investment bank. I spent more than 20 years working in the equity research department of a leading Italian bank. So in this position, I used to take into consideration the intangible. Why? Because the intangible were key for us as an analyst. So in this case, I am talking about an analyst, were useful to have a better comprehension of the company we were evaluating, in writing the SWOT analysis, the equity story, and also in the valuation. Because in the past, as Banca Akros, where I worked, we used to apply premium or discount to the cost of equity. Premium or discount related to sustainability and related to intangible. So I would like to give you two concrete examples on how we use the intangible in our M&A. A few weeks ago, mid-October, we announced to the market the most relevant acquisition in Unieuro story. We have both an Italian leader company providing services, repair services for smartphone, other mobiles. They are active also in installation of air conditioner, boilers, heat pumps, and also they provide services, home services with a network of plumbers, electricians, glazer, etc., etc. During the due diligence phases, we focus also on some intangible. We couldn't attribute a value to this intangible, but this analysis was extremely useful for us in order to have a more complete comprehension of the target and the business model, and also to support our investment case and to support the valuation. I would say also to support the negotiation in some cases. So I have listed some aspects, some intangible we took into consideration. Customer satisfaction. This company is a mid-small cap, and they were already measuring the Net Promoter Score. The Net Promoter Score is the KPI, the most common KPI to measure customer satisfaction in the retail industry. And the Net Promoter Score was high, but we wanted to double check. So we paid a third party specialized in survey, and we made a survey dedicated to the main B2B clients to have the confirmation of the numbers they gave us. Then we went to Trustpilot in order to measure the B2C reviews. We made a comparison with some peers. So in this way, we calculate, we take into consideration the corporate reputation. Then I said before, we went deeply inside the business model. I am referring not just to business diversification, to the scalability, to the business relationship, but also with a focus on the two networks of technicians this company is managing. And we had the confirmation that these two networks are key elements and at the basis of the value of this company. Then human capital. Beside the interview with the two founders, we wanted to make some interview to the rest of the management team in terms of skills, seniority, motivation, etc., etc. And in the end, also, we made a specific due diligence on the ITC system of this company. So we had a confirmation. We went ahead and we finalized the acquisition. But I would like to bring on the table another example, because we did the same exercise with another company a few months before, and we decided not to go ahead for the same reason, because during the due diligence, we realized that there were problems with the reputation. We discovered, for example, looking at the Trustpilot, that the reviews from the clients were extremely negative. So we decided not to go ahead, because otherwise we would have had the opportunity and the need to invest some money to relaunch the brand, to rebuild the network. Probably the best technician had already left the company, to improve, to strengthen the customer case, the customer care. So in this case, we stop.
I have a question for you, Tjeerd. Would you give a loan to Unieuro based on all this data? Because what we see in the market today is that, well, you hand over your balance sheet, if you have one, because if you're a new company, you don't have one yet. You have a lot of intangibles, a minimum viable product, you have a client database, you have a skill database for your employees or whatever. And then you go to the bank, and then the guy in the bank, he says, the computer says no. But this is a complete other approach. What is your opinion on, well, I don't ask you to talk from ABN AMRO perspective, of course, but from your own opinion.
No, I'll be happy to talk about from the ABN AMRO perspective, and it's important to realize that there's a difference, and I think most of people in the room know there's a difference between a loan and an investment, right? So there's a very much different also in terms of intangibles. So when you look at a loan, you look at the risk factor and are we getting our money back, right? That repayment, that's the, and if the risk is higher, you want to be repaid faster or you want a higher interest rate. That's how you typically look at loans. If we look at the loan space, also the developments from a regulatory perspective, then more and more ESG factors come into place. I'll call them ESG for now, you can call them intangibles, but when assessing a loan or assessing a company, more and more it's not just about the balance sheet. It's always, one of the previous speakers talked about the quality of management, those types of more, that's an intangible in itself, right? What is the quality of the management there? Regulations is now also encouraging us, EBA LOM regulations here in Europe, looking at, you know, what are we doing with our money? Where are the proceeds of our money? Which activities are we financing, and how sustainable are they? What is the ESG aspects of those loans? So this type of information is more and more relevant to a bank. In terms of loan, in terms of investments, it's a different case, right? And we've heard on the previous panel how investors and investor analysts look at this type of data, depending on whether they're impact investors or family offices or even hedge fund investors will look at it differently. But typically from a bank, this is information that they would like to see.
I think that more and more you want to know, information that is not on the balance sheet just to base your decision on?
Yes, we do, and we've seen also, and that's I've seen that slide come up in conferences like this many times this morning on the value of companies that is only, I forgot the percentage, but it's like 20-30% is in the financials, and the other 70-80% is in other stuff. So this is where finance teams or just the finance lens typically is not enough, and you need other types of loans. Just referring a little bit, and I know you meant this in a very friendly way, computer says no. Banks are under no obligation whatsoever to grant a loan to anyone. There's no, we don't have to do this. We will only do it if we feel we will get our money back. And we only make money if we grant a loan. So there's no objective for a bank to say no to a loan, because our business model is based on granting loans. So computer says no also means bank is not making money, right? So there's no incentive there. But the incentive is that we do, typically like to get the money back.
Yeah, if you don't have a repayment, you will not have benefits. Yeah. Ian?
Yeah, I think this is where we hit on the important difference between an intangible asset. So the Roche, depends what our share price is doing, but the Roche, there's typically a larger gap between the book value of the assets and the share price, maybe sort of 5 times or more. And why is this? Well, I won't comment on the share price, but I can say that the major assets of the company aren't on the balance sheet. And you can say some intangibles are a bit difficult to grasp hold of. Some are very easy to grasp hold of. If you have a prescription drug where you know how many people have the disease, you can get the prescription data from the market. This exists. And if you're selling 1 billion a year and you have a 10-year patent, and your gross margin is 80%, it's not rocket science to get some kind of DCF, and I suggest that's something you might be prepared to give a loan with that as collateral, yet that's not on the balance sheet. Some of the other things we talk about generally in the ESG environment, or the intangible environment, it's difficult to say, well, how would you value the intellectual capital, or would you grant a loan? I don't know. It's difficult to value it. That's maybe an intangible. Should we say more about it? Should there be disclosure? Yeah, maybe there should. But should we put it on the balance sheet? I have a question about that. But other ones, and you can look at specific industries. We heard about luxury goods. You can look at pharmaceuticals. You can look at industries such as media. You can look at Amazon and Google, certain areas. You can say, yeah, there's particular pieces of intellectual property or intangibles that you would actually pay money for on their own if you could separate them. And therefore, these are the ones you should be thinking about. Are these the intangible assets you stick on the balance sheet and put into the financial reporting? And then that sort of helps close the gap, or at least you have a sort of a standard way of looking at it. Whereas at the moment, you've just got sort of this bit of a mess where if you acquired the intellectual property through an M&A deal, it's on the balance sheet, and if you develop it internally, it's probably not. And that's basically the problem that makes the financial reporting in this area useless.
But if you can put it on your balance sheet, or if you put it on your balance sheet, meaning you have a stamp from an auditor.
I'm sorry?
If you put it on your balance sheet, meaning you have a stamp from...
Well, yeah, this is, I mean, the book you elaborate on, there's a lot of vested interests that don't want to fix this. We should be aware of that. I mean, I sort of sympathize to some extent with the ISB that they're a bit cautious about touching this, because as soon as you venture into this area, there's a whole load of people who have an opinion on it and don't want to change it. And from a company perspective, one of the issues is as soon as you start capitalizing stuff, you can lose control of your spending. I mean, if you want to lose control of your IT spending, just let the guys in IT start capitalizing stuff, and they'll spend loads of money for you. So part of the reason that companies like to expense it is actually to enforce budgetary discipline, which is very much in the shareholders' interest. But it's kind of like with, say, capital, like physical capital expenditure, CapEx, you've got governance processes about how you capitalize that and manage that. Intangible assets hasn't caught up with that yet, because the accounting standards don't require you to. You can just literally, you can control it by running it through the P&L and controlling it that way, which obviously you do need to control the spending on it. So there's lots of vested interest why it won't change.
Okay, thank you. Tjeerd.
Yeah, so I agree on the vested interest and the political debate around it. What I want to push back on is the fact that this is very difficult stuff. It's not. It's not very difficult, and it never will be. What is really difficult is financial accounting. That is apparently very difficult. It's been around, I heard this morning, for 500 years. Did someone say 500 years? Something like that, and at least for hundreds of years. Still, at a bank like ABN AMRO, which is not a very difficult bank, we are a very simple organization, we need 1,000 people within finance to figure out the numbers every quarter. Right? So apparently financial accounting is very difficult. It's well described, it's well structured, governed, whatever. But on intangibles or on non-financials or on ESG, even if you add them all up, we have maybe like 20, 30 people thinking about this stuff. And my position is that we will need more, but we will not need 1,000 to do this and adding 50 EY accountants every quarter to double check these numbers, these financial numbers. So apparently financial accounting, although very well regulated, standardized, governed, assurable, whatever, is in my view extremely challenging, and I'm not a financial accountant. So I'm just looking at this from the, the spend that we have to do to comply with traditional, not very innovative financial accounting. But I quite often hear the stories that, accounting on intangibles or on impacts or monetization of impacts or intangibles or ESG is extremely difficult. It's not. Ian.
It's not extremely difficult, but if you don't have your reporting system set up, you have to implement it. Just keep in mind, every Swiss franc that my company spends on any kind of reporting is a Swiss franc that we're not spending on finding the cure to cancer. So, what my job is to comply with what the regulations are, number one, and to provide management with what they need for the internal decision-making to run the financial reporting systems. And it kind of stops there. And anything else, that's for somebody else above me to say, yeah, and we want you to do more on this, and you want me to do more on that. The point is that, and every company is the same, what we live in the world as it is now. And the world as it is now, that companies, everybody has financial reporting systems, whether they're using an abacus or pen and paper or anything. And that's been built up to help the managers run the company. And I suggest a lot of people in the bank are doing that. Regardless of any financial reporting, banks have a certain obligation to do financial reporting. If you've looked at some of the financial crises recently, you can maybe imagine why, although standards such as IFRS 9 are somewhat heavy-handed in my view, and I sympathize with the financial services there. But all of this stuff is already in place. So if you think you want to do more on something else, you maybe want to do less on some other stuff that's actually not useful, that we're hearing, some of this stuff is not useful. So you might maybe want to think of a sort of one in, one out. And if then it becomes regular, say, yeah, we want to hear more about this and less about that, then we can switch off the stuff that's doing that. And then you can focus the resources on actually what people want to know and want to hear. And companies are quite happy to do that. But we live in the world as it is, and the regulators at the moment require my company to put 7 pages of disclosure on pensions, 5 pages of disclosure on stock options. I lost count of how much we have on financial instruments, 4 pages on leasing, and sort of half a page on R&D. That's what the standard says.
Yeah, and Ian, my question, is that all improving the decision-making of the senior management or the board of a company? Probably not.
They don't use it.
No, so, okay.
Do you imagine that we don't look at this stuff? We have all this information that you talk about, but it's run independently of the financial reporting systems, and it's what you see with a lot of ESG stuff generally. Folks are keeping an eye on this, but it's not sort of systematically, the data is not systematically collected. And as soon as you want to have it systematically collected, aggregated, consolidated, audited, filed with the regulator, you've then got to take the whole reporting to a level that it's not at the moment. And that's what people complain about when they say how much it's actually taking it to the next, from the Stone Age to the modern world.
Yeah.
That's
thank
the
you.
step you've got to make.
And
you.
I think the criteria there should be that it should enhance decision-making of senior management or boards of companies. We called it integrated thinking this morning already a couple of times. If that is the criteria, then let's follow that trail of thought and look at the information that senior management boards need to improve their decision-making. And that is a whole different way of approaching it than through reporting guidelines that we just have to comply with and are very much under development and are improving. I'm very much in favor of improving those reporting, so I'm not opposing that. Let's do more reporting, but let's have a look at it through a lens of improved decision-making, and that lens could very well be integrated thinking.
Thank you. Pietro, I would like to come back to you because when we were discussing I think yesterday evening you told me that, in fact, by doing this, you learned on the spot. And would you have done this in a different way, knowing, if you would know already now, instead of what you didn't know before? Would you do it the same way, or would you do some other things in your complete approach of customer satisfaction and business model and human capital? Because you learned a lot by doing.
Yes, and if I may, I would like to show you which are the intangible we have in Unieuro, because we have been working with different intangible. I have prepared a list for you. So let's start with the business model. The business model is important for us because it led us to become leader in Italy. Think that we started in the 80s with one store in Forlì. Now we have 530 stores. So from few thousand revenues to 2.9 billion euros. Then the brand name, which is one of the strongest in Italy, with the claim batte forte sempre, beating strong always, is very, very known in Italy. So we listen to people, we listen to customers, we listen to employees, we measure the net promoter score, the employees' net promoter score. These scores are inside the KPIs for short and medium long-term incentive of the management team. We are developing a leadership management tool because we are in the middle of a transformation. A transformation is important now because it's changed also our revenues pool. So we are not selling any more product, but we need to sell also solution, services, and the acquisition we made, it's critical to achieve this goal. So we are developing different projects. Just to show you the closing remark for us. So we have been working on intangible since a long time, listening to people, understanding needs and expectation, and developing project. Then using the NPS, the ENPS, and including this in our remuneration system, using and paying attention to intangible, to the M&A. So what are our next challenges? Probably the CSRD is important because we can adopt a more holistic approach, a more structured approach, and also to create a culture of intangible within the organization, within Unieuro, because we need to explain what are the intangible, why they are important, also because they are at the basis of the execution capability of our strategy. So we need to communicate internally and externally to the main shareholder, probably to the financial community, better, because we are listed, which are the key elements at the basis of our long-term value, and why we are able to execute our strategy.
Okay, thank you. I see that we still have 1 or 2 minutes, and I see that Sherry has a question. I will hand over the microphone.
Thank you, Michel. Michel, I want to thank you for this panel. Sharilyn from Institute of Management Accountants. I have a question. I've heard the discussion, the difference between information that is used for management reporting versus external reporting. Have you seen something along the lines of balanced scorecard that incorporates ESG or sustainability factors? I've seen it in the academic world. Is anyone seeing that in the practical tool in that respect?
Well, there's two ways that we use it within a bank. So one is the scorecard, which was one of the first questions, to grant a loan, where we have a scorecard on financials and ESG information, and both have minimum criteria and aspects to them. And we monitor some of those loans as well, especially the larger or higher risk loans. That's on the core activity of a bank. Then on the strategy side, or on the senior management board side, on how to steer a company along with its strategy, I think that's very company specific. Our finance and control teams monitor the progress on strategy, both on financials and non-financials. And a lot of those non-financials are sustainability related. And they put it in the scorecard for the management team and the board as an information. But it's not a standardized scorecard as such as you mean, Sherry, probably.
Okay, I see that it's midday. I want to hand over for the next speaker. I would like to thank the audience. Pietro, grazie mille. Ian, thank you. Tjeerd, dank je wel.
Ladies and gentlemen,